Hey guys, it's that Dividend guy coming at you with another Motley Fool list video. Today we're going to look at 3 dividend stocks to buy right now. So let's take a look real quick. First, we have Procter& Gamble. I love this company. I own this company. Full disclosure, I only have one share, but that will be going up. It is a dividend king, which means that it's paid a dividend for at least 50 straight years and it's raised that dividend for 50 years. It is a consumer staples giant, and it's paid dividends continually for 131 straight years, and it just raised its dividend for the 65th continuous year in April. It's maintained that streak because of its well-diversified business and the brands that they own, which are insane. They have Tide, Pampers, Tampax, Charmin, Gillette, Oral-B, Pantene, Olay, and Ski Too. So honestly, guys, Tide, Pampers, and Gillette's really the reason why I bought it. But Tide and Gillette are insane, and Pampers is huge too. So, guys, think about it. They own laundry detergent, baby diapers, female feminine products, toilet paper, razors, as well as toothpaste and toothbrushes. So it's everyday items, and that's really what it comes down to is people are buying these products regardless of what the economy is doing. People are going to buy toilet paper. Babies need diapers regardless of the economy. People are going to brush their teeth. People need to shave, and women definitely need feminine care products no matter what. So that's why I love Procter& Gamble. Happy to see it on this list. And it actually has bought a lot of other brands, and it's done a lot of buybacks and increased its dividends. So it actually reduced its outstanding share count by 11% over the past decade and spent 50% of its free cash flow on dividends over the last 12 months. Currently pays a yield of 2.6%, which is much higher than the 10-year Treasury at a 1.5% yield. And it profited from the pandemic because people still bought their products, like I said, regardless of what the economy does. And analysts are expecting their earnings to rise 6 to 10% respectively this year, and the stock is still reasonably valued at 23 times forward earnings and remains a solid long-term investment. Guys, you can't really go wrong with Procter & Gamble. Like I said, they have products that sell regardless of the economy. They've raised the dividend streak is insane, as well as the last dividend increase, I believe, was 10%. So they not only have continuous sales, they have a long history of rewarding shareholders, stock buybacks, and the last dividend increase was 10%. So I 100% agree with a Motley Fool here. Procter & Gamble is really never a bad stock to buy. Next is American Eagle Outfitters, which this one might surprise a lot of people because it's one of the companies that got slammed during the pandemic. But it did survive the retail apocalypse, and it's weathered the storm with 3 main strategies. Its namesake stores sold more than its popular jeans instead of diluting its brand with too many products. Second, it expanded its lingerie and active wear, which attracted shoppers with its low prices and body-positive marketing campaigns while shuttering weaker mall-based AEO stores. Lastly, it invested in its digital channels, which brought in 40% of its sales last quarter. It did suspend its dividend as the pandemic spread, but it reinstated that payout earlier this year. It also raised its quarterly dividend 31% to 18 cents per share, which gives it a forward yield of 2.1%. It boosted its payout because its business is improving. Its revenue fell 13% last year as adjusted earnings broke even, but analysts expect revenue to grow and jump by 32% this year with a return to stable profitability. Its sales have already risen by double digits over the past 4 quarters, and that growth should continue as it opens new stores and expands its e-commerce platform. It also remains one of the top apparel brands for U.S. teens, according to Piper Sandler, and will likely profit from pent-up back-to-school shopping trends as the pandemic finally ends. That's a bright outlook for a stock that trades at just 15 times forward earnings. So, guys, it is a cheap stock that did get slammed, but it's a retailer that has shown that it can hang when it comes to online sales, and they are rewarding shareholders with getting that dividend back to where it was pre-pandemic level. I probably wouldn't be putting money into AEO stock, but I do see that the trend is there, and they have um, brought back a lot of the appeal that they had pre-pandemic. Next is Best Buy, which is another retail survivor. It once struggled against Amazon and Walmart, but between 2012 and 2019, the CEO has really shaped up the business. It's improved its inventory systems, improved its employee training, expanded its e-commerce presence, and rented out its floor space to top brands as store in stores. It also matched Amazon's prices and used its stores to fulfill online orders. By the time Jolly handed the reins to the new CEO, it was growing by a healthy clip again. Best Buy kept most of its stores open during the pandemic, and its stay-at-home trends helped it because its revenue rose 8% in fiscal year 2020, which ended February. Its domestic digital comp skyrocketed 144%, and its adjusted earnings surged 30%. And it will face tough comparisons after the pandemic ends. But analysts still expect the revenue earnings to both increase by 4% this year. In other words, the stock still looks cheap at 13 times forward earnings. Best Buy continued to pay its dividends throughout the crisis and raised its annual payout for the 8th straight year this February. It spent just 17% of its free cash flow on those payments over the past 12 months, so it has plenty of room to raise its dividend. So, guys, you have two retailers. Out of the retailers, of course, Best Buy I think is way better than AEO because they never suspended their dividend, and they have a direct benefit from the stay-at-home kind of revolution. So I think AEO is definitely the weakest out of these three. Yeah, teens might like their clothes, but malls are going out of style even if they are shifting to a more e-commerce friendly business model. I just don't see it growing by a steady, healthy clip. Revenue fell, but with Best Buy, I do think that they have really helped themselves, honestly. When it comes to retail, companies get eaten alive by online. Vendors and Amazon specifically. But I have seen a change with Best Buy. The customer service is a lot better when I have Best Buy at my locally, and I think that they've done a lot better. I did notice that they do have floor space rented out to, I believe, Samsung and Apple, maybe even Google now as well. So they're using the stay home revolution as well because they had great online growth as well as in store sales on iPhones, laptops, Macs. They're using the stay at home revolution to boost their sales, which is phenomenal. But honestly, before the new CEO switch, I don't think that they could have done as well as they did in this pandemic type environment. So, out of these three, of course, my favorite is definitely Procter and Gamble because they have consumer brands that I use every day. I use Crest and I use Gillette deodorant and Gillette razors as well. So they're by far my favorite. And as well with my niece and nephew, we use Pampers. So in my opinion, first is Procter and Gamble, then Best Buy, simply because I feel like it's a lot more flexible when it comes to online and e-commerce, and they've used this new downfall of a pandemic and used it to their business model, adjusted properly, and even grew when a lot of other retailers were struggling. And last, of course, AEO, American Outfitters. I don't have an issue with their stock. I don't have an issue with their business. Their demographic is teens. I'm 25, so I don't really shop there anymore. And I feel like a lot of, older generation, I guess, like 20s and above, they don't really shop there as much anymore. And a lot of their stores are dependent on mall traffic, and we all kind of know where that's headed. So I just feel like their business model needs shifted more into an e-commerce style and needs to be less dependent on a retail environment. But from what it sounds like, they are doing that, and they are coming back pretty strong out of the pandemic, but they're just not selling high market items, in my opinion. I don't think jeans are going to make a big difference, not like selling Apple and Samsung products. So they're in a highly competitive market when it comes to clothes. And yes, the back to school will help them, but the consistency of that when you have, I mean, even just in my local mall, there's like 15 stores, it seems like, now selling relatively the same clothing like lineup. So what makes American Eagle better than, Buckle or any of the other stores that you see in a mall? I don't know. But, if you own American Eagle, great for you. Hopefully, you're happy about that dividend being reinstated. That is a good sign, as well as they are investing heavily into online stuff and to e-commerce, which is great. So it sounds like they're moving their business to a more healthy option and a more profitable path, which is phenomenal. So I'm happy about that. It's just not a stock that I personally would put my money into. But guys, so for me personally, Procter and Gamble, of course, I'm in this stock, so I have to put that first. And then just from the business and the perspective of the changes that they've been making, Best Buy definitely, for me, outpaces American Eagle. But it sounds like American Eagle is kind of getting back into the swing of things. So let me know what stock you guys like the best. Let me know if you own any of these. And if you dislike any of them or have any alternatives to these stocks, let me know down in the comments below. It's always cool to get perspective on, viewers, from viewers, and see exactly what they think about some of these lists. So thank you guys so much for watching, and I'll see you guys in the next list video. Take care.